From the world of politics to the world of business, this is Balance of Power. Live from Washington, D.C.
I'm Joe Mathieu in Washington. Thank you for being with us. You made it to Friday, and it doesn't feel too good as we watch the markets tumble as investors listen to Jay Powell there. Some really interesting news there concerning as well the risks, he says, of higher unemployment and higher inflation have elevated. In light of the tariffs, he spoke directly to President Trump's tariff regime that has sent the markets on a spiral this week. The tariffs are likely to cause higher inflation and slower growth, he said, likely to raise inflation in the coming quarters, going on to say that the possible tariffs could have a persistent inflation impact. That is what has spooked the markets here as we listen to Jay Powell speaking live. Quote, this is the quote, while tariffs are highly likely to generate at least a temporary rise in inflation, it is also possible the effects could be more persistent. And this comes off a Truth Social post from Donald Trump, who in fact called on Jay Powell to cut interest rates just moments before he took the stage today, writing on Truth this would be a perfect time for Fed Chairman Jerome Powell to cut interest rates. He's always late, Donald Trump wrote, but he could now change his image and quickly. Now, this has been a very difficult day on the markets. It was before the Fed chair started speaking, and we just reached to new lows while he was talking. And that's why we want to bring in, before we do anything else, Charlie Pellet with his view on Wall Street from world headquarters in New York. Charlie, how's it look?
And right now we are just about lows of the day with the Dow, the S&P, NASDAQ very much in the red, Joe Mathieu. Right to the numbers here with the S&P down another 4% today. The S&P 500 index now tumbling by 217 points at 51.79. We've got the Dow down 3.4%, 1397 lower, right now at 39,153 on the Dow. NASDAQ is down 668 points, another 668 down 4%. The Russell 2000 index of small cap shares slumping now by 4.6% with a 10-year that's currently yielding 3.93% with a 2-year at 3.61%. Spot gold right now down 3%, 3,021 the ounce. West Texas Intermediate crude lower by 7.6%. WTI right now 61.85 a barrel. The trade fight weighing hard on shares of industrials and materials companies, including tool companies Stanley, Black & Decker, machinery builder Caterpillar is lower as well. Right now we have got shares of Caterpillar down by 4.9%. Stanley, Black & Decker down 4.3%. Among other manufacturers, Harley-Davidson down 4.3%, and Whirlpool right now down by 2.8%. So the sell-off driven by worries about President Trump's tariffs, pushing the economy into recession. Again, the S&P keeping it all in context right now, down by 4.1%. Back we go to Washington. We got more on the economy, more on the Fed, more on the sell-off coming up right here on Balance of Power. And once again, your host, here he is, Joe Mathieu.
Thankful to have Charlie Pellet with us on this Friday edition of Balance of Power. We'll get back to Charlie a little more than 10 minutes away as we keep a close eye on the markets today, even as we cover politics here from Washington. The fact of the matter is you cannot separate the two right now. Wall Street has been keying off of Washington for weeks, and it just got worse with Jay Powell speaking a short time ago, reminding this is jobs day. That would actually be our probably lead story in any other world, with growth topping all forecasts in March. Non-farm payrolls, 228,000. But clearly this data is rear view mirror, because we've got a whole new world that we're dealing with now. And we're going to be updating the push and pull here with the tariffs. We do have a couple of updates for you here, based largely on Truth Social. We're really just hearing about this from the president, knowing that China said it would retaliate here, hitting all U.S. imports with a new 34% tariff. President Trump writing on Truth Social, China played it wrong. They panicked. The one thing they cannot afford to do. That was followed up a short time later with a truth about Vietnam. Just had very productive call with To Lam, General Secretary of the Communist Party of Vietnam, Donald Trump writes, who told me Vietnam wants to cut their tariffs to zero if they are able to make an agreement with the U.S. I thanked him on behalf of our country. Are we about to get 10 more of these? Would that change the vibe on Wall Street? That's kind of the big question right now as investors head for the exits. And a lot of people are very worried about staying long into this weekend because of what might be waiting for them when the bell rings on Monday morning. Let's start with the economic side here. And our friend Stuart Paul, the U.S. economist at Bloomberg Economics, is with us live from New York on a jobs day. Stuart, do we pay any attention to this report, or is it already old?
It's already very old. Life comes at you fast. It comes at you even faster when Trump has his cell phone and is all over Truth Social. So the March jobs data are a bit stale. I think that if we're going to take anything from the March jobs data, it should be this robust payroll growth plus relatively rapid wage growth and no material change in the length of the work week. That spells about 0.5% personal income growth for the month. We're not going to get that data for another 2.5 weeks, a little bit longer. And so if we're thinking about whether consumers can continue spending through the month of March, through the month of April, they probably can. Now, if I'm Chairman Powell and I'm worried about folks spending and bidding up the price of goods to try to get ahead of tariffs, to get ahead of the price hikes that they're anticipating, they're going to be applying upward pressure on prices. I think that that's the most material takeaway we can get today from the jobs report.
Interesting. Still too early to see the impact of the Doge cut, Stuart?
It is too early. Federal government hiring was pretty slow. Still seeing a lot of local and state government hiring. We're not seeing a major shift in terms of jobless claims in the weekly jobless claims reports. We are seeing from Challenger, another Challenger survey reports on annual growth in layoffs. We are seeing a lot of planned layoffs, of course, but that doesn't give us much data, true data, beyond just what we're seeing in the headlines.
You consider the dual mandate here, the headline on the terminal, Jay Powell, tariffs likely to raise inflation, risks of higher unemployment and higher inflation elevated. What could we be looking at, I should say, when it comes to jobs reports 6 months from now?
We think that the unemployment rate is going to be heading higher, ending the year a bit over 4.75%, closing in on 5% to end the year. And I think that a big part of that is because the Fed is so committed to the other leg of its dual mandate, the price stability element of its dual mandate, by trying to convince folks that they are committed to a 2% average inflation target, and by trying to keep inflation expectations reasonably anchored at low single digits at least. The Fed is essentially emphasizing that they're not rushing to cut rates anytime soon, and that's what's going to untether the unemployment rate, we think. So we think that, yes, today we just saw a very minor uptick in the unemployment rate, but we think that we could get a more substantial and a swifter rise in the second half of this year, in part because the Fed is moving a bit slowly. Now, that's not to endorse what you mentioned President Trump said on Truth Social.
Yeah.
He said that the Fed typically moves a little bit slowly. The Fed has to, at this point, be reactive. It has to be reactive to the printed data, and the printed data is going to move even more slowly than sentiment, which is moving based on what we're getting out of Washington. So there's this long chain of action that has to take place before we actually get interest rate cuts. Those rate cuts are probably going to only come late this year, and in the meantime, the unemployment rate is going to continue rising into year end, we think.
Yeah, late is different than slowly. In no hurry is the headline. Feels like we don't need to be in a hurry. We have time. That was a red headline on the terminal. Jay Powell speaking earlier. Stuart Paul, thank you so much on a jobs day from Bloomberg Economics in New York. We want to add the voice of Ed Harrison, whose headline caught our attention this morning. Bloomberg senior editor, author of the Everything Risk newsletter, where the headline says it all. The jobs report is actually bad news for stocks and bonds, too. Edward, it's great to have you back here on the program. I appreciate this. Now, of course, you add everything that happened after you published this column at 9:14 a.m., and you wonder where Jay Powell's head is. The fact of the matter is this came in hot, and it just adds to the confusion that we're dealing with here. When people are calling for rate cuts, doesn't look like that's happening anytime soon.
Yeah, it seems he confirmed what I was saying in the post, Joe, and that is that they're going to take a wait-and-see approach. They're going to continue to hold And if the inflation numbers are too high, there's nothing they can really do about it unless the labor market really falls out of bed. And so that's not good for the bond market, which has been rallying on the concept that they're going to get these rate cuts. But the fact of the matter is that Jay Powell wants to keep inflation expectations anchored, and he's afraid that they could become unanchored, and therefore he's not going to cut rates.
Let's hear from Jay Powell right now. Sam, if you could do that for us in New York. We just heard about a half an hour of commentary, prepared remarks, and Q&A. This is the line that matters to the market. This is why we saw conditions deteriorate. The Fed chairman here from earlier.
While uncertainty remains elevated, it is now becoming clear that tariff increases will be significantly larger than expected. And the same is likely to be true of the economic effects, which will include higher inflation and slower growth. The size and duration of these effects remains uncertain.
Investors doing it for him here. The bond market's doing it for him, Edward. 10 years back below 4%. And how? We're at 3.93% right now. What does that tell you?
It tells you that the bond market, it's almost thinking a recession is a fait accompli. I think that really what we're seeing now is just a flight to quality. Some of the levels that we're seeing in terms of the rate cuts, in terms of the actual yield, they aren't necessarily indicative of what we're going to see in a week from now or 2 weeks from now. This is just the knee jerk. Once we have time to process what the Fed has said and how things progress, I think that some of that flight to quality will be backed out. And we'll see that bonds, the bond yields will reverse to a certain degree. Hopefully not entirely, but there is the possibility that, yes, this post Liberation Day rally is entirely erased because the Fed is unable to cut because of the inflation.
Wow. Well, this is getting to be something, Edward, and we've got a couple of IPOs canceled now, StubHub as well as Klarna pausing their plans to go public because of everything that's happening. Some of the analyst notes this morning are deeply concerning. And unless Donald Trump does something this weekend, maybe it's exacting concessions, maybe it's backing off implementation of some of the reciprocals. On the 9th, we get the baseline that takes effect tomorrow. I mean, what are we going to look like on Monday morning if Donald Trump is sitting in the Oval Office with his arms crossed, not changing his tune on this?
You know, I think it was interesting that you talked about Vietnam and China, the juxtaposition there, and the fact that Harley Davidson, I think actually Jay Powell was asked about Harley Davidson moving production from China to Vietnam and then getting whacked anyway. It's an indication that there is room for negotiation in these tariffs, that really, this is just the baseline. Potentially, you could see the numbers come down significantly if the individual countries are willing to play ball. As the post from Truth Social seems to say, we saw that with Mexico. We may see that with Vietnam. So potentially, we're going to see something of that nature. But, the market is very much shocked at how high these tariffs are and the inflationary implications of that.
JP Morgan hiking recession odds today to 60%, up from 40 before the announcement of tariffs on Wednesday afternoon. Edward, is that an outlier? What are the markets saying about the R word?
Well, yeah, I think that is not an outlier. That is what the market is effectively saying. If you look at Fed fund futures, you look at swap rates, which show you what the market's predicting in terms of interest rate cuts. They're predicting 4 interest rate cuts, potentially a 5th, all within the space of this year alone. And given the fact that we all know that inflation is going to be 3.5, who knows, as high as 4% at points in this year, that's only possible in the case of a recession. So very much so that is potentially the base case that's now being priced in to the bond market.
perfect time to speak with the author of the Everything Risk newsletter, Edward Harrison. We missed you, Edward. Thank you for coming back. Bloomberg senior editor with us today on this Friday edition of Balance of Power. We've got our eyes, of course, on the Friday trade. That's what this is all about. We want to bring Charlie Pellet back into the conversation from World Headquarters in New York with his eyes on stocks and bonds today. Charlie, take it away.
All right. Thank you very much, Joe Mathieu. Lower across the board on this Friday, on track for yet another losing week for the U.S. equity market. But you want to know what's going on right now. The Dow, the S&P, NASDAQ deeply in the red. We have got the sell-off intensifying, bonds pairing gains, oil trading at a 4-year low. Fed Chair Jay Powell, you heard him on Bloomberg, reiterating the central bank's wait-and-see approach despite signaling the economic damage of a trade war that will be bigger than anticipated. Another 4.5% drop right now for the S&P 500 index, down 244 points to 5151. The Dow is down 1,591 points for the Dow, a decline of 3.9%, while NASDAQ is lower by 775 points, down another 4.7%. The 10-year at 3.92%, with a 2-year currently yielding 3.60%. Gold is down $91 the ounce to $3,024, a drop there of 2.9%. Crude oil slumping 7.7% at $61.77 a barrel, and Bitcoin higher by 0.7%, 82,888 on Bitcoin. Stellantis, the parent of Jeep, Chrysler, and Fiat, offering employee discount pricing across its brands as the maker of Jeep and Ram vehicles seeks to lure buyers into its showrooms after President Trump's tariffs sparked fears of rising car prices. Stellantis down 5.4%. Ford, meanwhile, down by 0.1%. So again, stocks lower across the board here. S&P down now by 252 points, a drop now of 4.7%. Balance of Power continues right now. And back we go to Washington. Once again, your host, here he is, Joe Mathieu.
All right, Charlie Pellet, we're just letting the headlines wash over us here along with the numbers that Charlie is bringing from New York. This is pretty scary stuff. And I'll tell you what, if Ryan Reynolds can't keep his cool, I don't know what I can say about the rest of us. Yeah, Ryan Reynolds. This company that he's involved in, actually he's the Chief Creative Officer, MNTN, a connected TV advertising platform set to go public, just put off the IPO. Was planned for next week. Ryan Reynolds, MNTN, said to delay the IPO amid the market rout that follows Klarna now and StubHub, saying, guess what, guys? No thanks. We'll come back on another day. And who could blame them, not wanting to wade into the waters that Charlie Pellet there is just describing? So maybe it's a weekend for a little aviation gin, everybody, although now that I say it, don't we have to go out, stock up on our favorite imported wines this weekend? Baseline takes effect tomorrow, right? Reciprocals next week. Time to load up on the Brunello di Montalcino. Tariffs were front of mind when we spoke with the governor of New York yesterday. This is a big deal in New York, and of course they're sharing a border with Canada, so this has been a big deal for longer than just Wednesday. Kathy Hochul, the Democrat, speaking to the impact that these tariffs would have on New York. Let's listen.
The impact on New York, let me explain. This is the 10th largest economy in the world. We have Wall Street, we have farms, we have a border 450 miles with Canada. So we have a trade relationship with Canada over $50 billion. So already, here's what we're seeing. Droppings in bookings from Canadians coming to New York State, a huge source of tourism all the way to New York City, but certainly my hometown of Buffalo, where Canadians come over all the time, and they go to our sporting events, they shop in our stores. So here's number one. Sales tax revenues are dropping already. Now, speaking to a farmer in a very Republican part of our state, I'd call it Stefanik country in the North Country, he told me that as a dairy farmer, he gets his shavings, he gets his fertilizer, he gets all these products from Canada, and his costs are going up $10,000 a month, a dairy farmer. Not the total cost, but an increase of $10,000 a month. So there's such anxiety now, not to mention the Walmart mom who goes to Walmart like I did when my kids were little, that giant grocery cart with the oversized diapers and lots of baby food and paper towels. that's going to have an impact on people shopping at Walmart who come out of the trailer park like the one my parents grew up in. So I have to say, it goes all the way from Wall Street to the farmers, to the small towns, Main Street to Wall Street. There is a cataclysmic effect on this, and New Yorkers are reeling right now.
I hear where you're coming from here, Governor. I wonder if there's a silver lining in any of this for the great industrial towns of your state from the last century. Syracuse, Rochester. Based on what we're hearing from this administration, they will again have a seat at the manufacturing table. Do you believe that?
I hope so, but we already have advanced manufacturing coming to New York. I literally got off the phone with someone who's in a pharmaceutical business looking all over the world, and he's very likely, with the deal I'm making, to come to New York. So we have advanced manufacturing, we have pharmaceuticals. In fact, I was able to lure Micron with a $100 billion investment, the largest in our nation's history, to build semiconductors in the Syracuse area. So we're already reimagining our economy based on manufacturing, so that's important to me. I come from Buffalo. I mean, my dad worked at the steel plant. I know how hard it is when businesses leave, but we are backfilling in with businesses that we think will have a long-term future, and they'll be affected by this. The component parts to what they're building and the supply chain, they're going to see an increased cost, not just because they're in New York, but because they're in America. And that's what worries me. There could be a silver lining, as you say. I don't know how old I'm going to be when that happens. I mean, what are they going to do? Start building factories now? And, you know, I just don't know. All I know is that people were promised lower prices on Inauguration Day, and guess what? They're going up.
Well, is there anything you can do about that, Governor, regardless of what policy is set by the federal executive? You as a state executive, are there levers you can pull to help offset any economic pain that results from these tariff policies?
Well, I've had to have this conversation. I'm assembling some of the smartest economists in the country to help give us advice on this. This is an unforced error. This did not have to be this way. And yes, you can use tariffs as a tool to negotiate or, you know, have something in moderation. But this is so extreme and so immediate that I need to figure out with some real experts on what this is going to do. But I'll tell you what's going to happen. Wall Street goes down. Next January, when I'm looking at my revenues that are coming in from Wall Street bonuses, where I fund a lot of the generous programs we have in our state, that's going to be lower. I'm going to have to look at where we're going to have to cut there. I have to look at the whole picture now in the context of the budget I'm negotiating, the revenues I count on, the revenues I'm going to lose, but also the impact on our businesses who may not be expanding now. So I have to find ways we can use state resources to say, we'll help calm it down. What I can do for a farmer in upstate New York, that's a good question. I don't want them to suffer. 32,000 farms in our state. People think of New York as just Manhattan. I know they do. But it's so much more than that. An important part of our economy is our agricultural sector. So all of our sectors are going to be hurt. So I have to look at our budget, what we can do to help, other incentives for economic development. And as I'm doing, I'm trying to put money back in people's pockets. I mean, the average New Yorker will have $6,000 less in their pockets because of these tariffs, and that's an opinion by a number of economists. I have a budget I'm negotiating right now that puts $5,000 back in people's pockets. Child tax credits, a middle-class tax cut, the largest in 70 years, the largest tax rate decrease in 70 years, an inflation rebate for people who paid so much more in sales tax. So I have a path to put all this money back in their pockets. You know what's really sad? That's going to be sucked right out with the $6,000 they're going to lose because of tariffs. So I'll keep fighting. I'll keep doing what I can do, but this is a real hit on New Yorkers.
So it sounds like the potential for state tax cuts in the year ahead depend on tax receipts from Wall Street, Governor. Is that right?
Oh, it always does. I mean, I've not had an increase in our income tax because I want to make sure high net worth people know we appreciate them, and I don't want to drive them out of our state. So that's my view. But
does it increase the urgency behind extending the Trump tax cuts and eliminating the SALT cap? Because a lot of Republican members of Congress in your state are working to do that now.
Well, they better be successful. We want to make sure that the SALT deduction, state and local tax deduction, is brought back 100%. Absolutely. And I have 7 Republican members of Congress. You better win on this one because you promised your voters you would.
That's the governor of New York, Kathy Hochul, speaking with us late yesterday, the late edition of Balance of Power, with her eyes on tariffs. This is, of course, before we walked into the news today. Before we heard from Jay Powell with another leg lower here on Wall Street, the S&P 500 now on pace for its worst two-day rout since the COVID lockdowns of March 2020. That's where we are here in our time machine, as we also watch the price of oil fall precipitously over the past several sessions here. Crude oil futures, West Texas Intermediate, now below $62 a barrel. WTI down 8%. And when we see a drop like that, we tend to reach out to Mr. McGlone, who joins us right now from Miami, covering commodities for us at Bloomberg Intelligence. Mike McGlone. And I know if I'm talking to you, Mike, twice in 24 hours, something is not going well here. We had the OPEC story, but it looks like the tariffs are really driving the price here, no?
Yes, well, at least it's going the right way for consumers. And the commodity traders don't really like when prices drop, but this is great for consumers. And it's an indicative of what's happening in this country. We have a massive glut, an excessive glut of crude oil and liquid fuels, and the market's going that way. So the average cost of production to produce crude oil in this country, according to Bloomberg New Energy Finance, is around $50 a barrel. We're going to that level. It's just a question of time. And now we have a decent catalyst to get there. The stock market going down was just one of those things that helped push it lower. It's the key thing, as I have to say, Joe, is those who have listened to me before, I've been saying this for 2 years, and I think it's eventually not going to bottom until it gets to below 40 or around 40, which is what it's done for the last 20 years. Yeah.
What does that mean for gas prices this summer?
Exactly. So this summer, no, gas prices are up a little bit now because it's a seasonal thing. But by the time we get to midterms next year, I think gas prices are more likely to be around $2 a gallon versus closer to about $3.25 right now. It's just a normal cycle. So the last 20 years, gas has always bottomed around 4 or lower after it goes above, bottom around 2 or lower after it goes above 4. And same thing in crude oil. Every time it gets above 100, it usually bottoms around 40. The thing that's changed from the past is most of the time in the past, U.S. was a net importer. Now we're a pretty significant, massive net exporter, and our new government is just going to increase and continue to do that. So we have a glut. We have to export it. And that's the same thing in some of the grains. That's why those prices are lower. We have to export. And if there's a trade war on it, pressures those commodity prices. So it's very good for deflationary forces.
Can you drill, baby, drill and even increase production when you've got $50 a barrel?
Well, that's the key thing. We're not there yet, but what we've been seeing for years now in the futures curve, it's called normal backwardization. In the futures curve, you can see prices are lower in the future. They used to say that's bullish, but now what I think it's showing is those producers are selling forward and hedging a bit of their production. And right now, it's still a good sign. But the key thing is for the last 10, 20 years or so, to really shut off that trajectory of U.S. production increasing versus consumption, is that prices have to go down. And it's the force of price. And for now, the prices are still sufficient for us to produce more than we consume and for prices to continue to get to that level. That's what I call it. In the grain, people call it the low price cure. We're heading towards that low price cure, and it's just a matter of time I think we get there.
Normal backwardization. I feel like you're describing the way my brain works or something there, Mike. I like that. Did you come up with that?
No, I think Maynard Keynes wrote about that about 100 years ago. But it's a concept that in futures that switched back and forth.
Yeah. I always love talking to you, Mike. I appreciate it. What a week for crude. We didn't even get to gold, which is also lower today as this global sell-off continues in the wake of the tariff announcements. Mike McGlone, Bloomberg Intelligence. Look for him on the terminal and online for the smartest analysis in the energy space. We'll assemble our panel next. We've got a lot to talk about right here on Balance of Power, only on Bloomberg. Chime, you ever heard of this company? Chime Financial, delaying the IPO. After we heard from several others, including StubHub, right? We got that one, Klarna. Even Ryan Reynolds decided to pack it up. MNTN. We got another one, James? Look at this. 8 Gritty Specialty Holdings said to delay IPO plans. Ensure, I guess I'm saying it right. 8 Gritty said to join other companies delaying IPOs. Remember Animal Spirits, everybody? We were coming in off the top rope on Inauguration Day. Charlie put his finger on another one. Goldman Sachs. Stock topped out on the 18th of February, $672. Animal Spirits. It is now selling for $474. The IPOs are dropping. The stocks, of course, are dropping. Bonds are holding up right now, as we discussed with Edward a little while ago, but it's anyone's guess how long that will last after Jay Powell told us they're in no hurry to cut rates. That's when things really turn south here. We brought you live commentary from the chairman of the Federal Reserve codifying the idea of tariffs leading to inflation, and it is changing the outlook at the Fed. In his prepared remarks before they even got to questions, Jay Powell talking about risks of higher unemployment, higher inflation, now elevated, tariffs likely to raise inflation in the coming quarters, tariffs likely, the economic impact of tariffs likely larger than expected. And then the cherry on top, feels like we don't have to be in a hurry. We've got time. So if you're betting on rate cuts, that may not be working out too well either. And that's where we start our conversation with our signature panel. Rick Davis is here, partner Stone Court Capital, Republican strategist, and Jeannie Shanzano, senior democracy fellow with the Center for the Study of the Presidency and Congress, Bloomberg Politics contributors. Rick, I remember a period of time that, of course, helped to inform your view on things here when you were helping to run the McCain campaign for president in 2007. And it was your decision to bring the campaign to a halt because of what was happening in the economy. This was the beginning of the Great Recession. And we thought we were on the precipice of something much worse. And I think you could probably argue that we were. You went to the White House, where President George W. Bush was still in office, and you put together a meeting to help prevent the end of the economic world order as we knew it. Are we at another point in time like that today?
You know, I think you alluded to it. I don't think it's as extreme as that. You know, these were global structures. Banks were failing. The stock market went down substantially more than it has already gone down since the trade regimes went into effect over the last, a couple months. But it was more functional, right? It reached into every aspect of the financial network that existed in the world. And so, it was bad, and it had horrific political ramifications for the party in power, Republicans. And I know there are a lot of comparisons being made now. We have yet to see the bottom. We now know where the great financial crisis ended and how we recovered from that. I'm not exactly sure we know where the end is as these countries like China retaliate with their own, trade barriers, and other countries likely will follow. So I think we're just at the very beginning of a global trade war that, as of today, wouldn't be as bad as the great financial crisis, but as it continues, has maybe the potential to become as bad as that.
Jeannie, I'm sure you're looking at what Donald Trump is writing on Truth Social today. There have been a lot of posts, but the one that stands out to me in this conversation, he writes to the many investors coming into the United States and investing massive amounts of money. This is all caps lock. My policies will never change. I think he was trying to say that as a good thing, saying, hey, if you come here, you can rest assured that we're not going to turn on you. But saying at this moment, when the market is in free fall, my policies will never change, tells you what?
Well, he followed that up a few hours later with a similarly bombastic notion that he would be willing to negotiate, whether it pertains to Cambodia. And then yesterday he mentioned, hey, maybe we can negotiate with China as it pertains to TikTok. And I think that is part of the problem here. Unlike the example you were talking to Rick about in 2008, this is a self-inflicted wound. The president told us he was going to do this, and he did it. And the question now is why? And the administration cannot answer the why question. At times, it's about negotiation. We're going to negotiate. Okay, many people are willing to accept that. At times, it's because we want to even the playing field. That's not going to happen with companies, or rather countries like Bangladesh. We're never going to even that playing field. Other times it's to bring us back to the beautiful days of manufacturing in the US, reshoring here. All of those are fantastical ideas, They may be understandable. We'd all like more manufacturing here, but they're not going to happen in the short term. And so until the administration and the president can say why he's done this and inflicted this chaos around the world, that this is going to remain a problem. And that basic question, why, Mr. President, why are you doing this? He has been unable to give us an answer.
The IPOs are dropping like flies, Rick. Integrity, I think I butchered that before. Chime Financial, MNTN, StubHub. What was the other one we had? Klarna. How many of these do we need before Donald Trump looks at this a little bit differently? Or am I just asking the wrong question here? He's not looking at this at all.
Well, he's got to be looking at it. And I know that a number of his advisors are trying to think through ways to try and mitigate the economic impact dislocation here in the United States. But as Jeannie said, it's really a function of their own doing. There weren't any advisors I know who thought this wouldn't happen, right? In other words, everybody expected markets to react negatively to this kind of approach. And the fact that it wasn't sort of walked out early and tested and people could get used to it and run models against it before it was actually implemented, I think is really the biggest issue. By just surprising people on the eve of implementation, there were so many ramifications to consumers and to financial organizations and to corporations that use trade as a mechanism. Nobody could be ready for it. And even though he'd warned us that this was going to happen, I think it's still very much a shock, and still people are reeling with the idea of how long is this going to take to normalize, if it ever does, and what cost is it going to be to them? Can they survive it in the process?
Well, of course, Donald Trump would say, "Hold on, Jeannie. You're looking at the wrong post on Truth Social. This is, I think, what the White House would call progress. This would be qualified as my plan is working." Just had a very productive call. By the way, none of these in caps. Just had a very productive call with To Lam, General Secretary of the Communist Party of Vietnam, who told me Vietnam wants to cut their tariffs down to zero if they are able to make an agreement with the U.S. I thanked him on behalf of our country. What happens, Jeannie, if we get a dozen more of these over the weekend and the S&P 500's up 5% on Monday? Is that also possible?
It certainly is possible. I mean, none of us can read the future. And that gets back to what I was saying. If he's using this as a negotiating tool, many members of Congress, particularly on the Republican side, they are open to that. And they're saying exactly with this conversation with the leaders, whether of Vietnam, Cambodia, that absolutely makes sense. But the reality is there are many countries on this list. We are never going to have, we will always run a trade deficit, because in return for that, we have gotten cheaper and better goods from them. That's the way this has worked. But yes, if it's a negotiating tool, that's fine. Why a few hours ago, though, did he say he will never change his policy? And this gets me back to the goal. When we do something in public policy and it impacts so many people's lives, tell us why you're doing it and what the timeline is roughly and what the end game is. And we haven't gotten any of that clarity from the president. We know he's committed to this. We don't know how, we don't know why, and we don't know what the end run is here. And in the meantime, the pain is very real. And we have a right as Americans to say, is this pain worth the end goal? It's hard to answer that if you don't know what the end goal is.
Rick, JP Morgan analysts are hiking their forecast for a recession to 60%, up from 40% after the announcement this week at the White House. Is there an equation or a model that you can use as a political practitioner to see what that means for Donald Trump? If we go into a recession this year, what does that mean for midterms? What does that mean for favorability ratings, right track, wrong track, et cetera?
Yeah, well, I mean, I experienced a similar situation. And as you remarked, the 2008 presidential campaign, voters took it out on a party. They didn't take it out on an individual. The Bush administration was ultimately responsible, and yet it reflected on our campaign and John McCain's, winnability. We went from being 5 points up to 5 points down in 1 week following the 2016 or 2008 crisis, and yet Republicans lost even substantially more. Think about it. We had historic losses in the House and the Senate. And I think the way to look at it is right off of what we experienced this week. We saw that House races in Florida that Donald Trump won by 30% still stayed Republican, but they stayed Republican by half that amount. If you look at every Republican in the country who won in a Trump district where Trump won by a dozen points or less, you're talking about 40 members of Congress who could be at risk today for reelection. I mean, that is a significant rewrite of midterm strategy versus, Republicans in a +3 district might be vulnerable. So as you see the public sentiment turn against the Republican Party for what they would perceive as fiscal mismanagement, you have to start moving that window out of the number of members that might be at risk.
Rick Davis and Jeannie Shanzano, quite a conversation on the Friday edition of Balance of Power. Thank you both. This is Bloomberg.
From the world of politics to the world of business, this is Balance of Power. Live from Washington, D.C.
President Trump says his economic plans are already working, even as stocks tumble again. Welcome to the fastest show in politics on this day that markets throw another tantrum over tariffs. I'm Joe Mathieu alongside Kailey Leinz in Washington. Thank you for being with us on the Friday edition of Balance of Power. Kailey, much like we were talking yesterday, the S&P 500 on track to have its worst week since the depths of COVID.
Yeah, the worst two-day sell-off potentially since March of 2020 when those lockdowns were at their height. That is, of course, after China decided to retaliate against U.S. tariffs by placing a 34% levy on all U.S. imports into that country. And President Trump suggesting that he's not going to change his policies, that they are here to stay. Meantime, the Fed isn't signaling a change to policy anytime soon, as Chairman Powell reiterates that while tariffs may pose, in his words, a persistent inflationary risk, the Fed is still in no rush.
In no hurry to cut interest rates here, so we've got a bit of a quandary. It was interesting. We carried his remarks live right before the noon hour, Kailey, and that's when markets really started to reach lower. Jay Powell not making anybody feel better on what is jobs day. Payrolls came in hotter than expected. In any other world, this would be our top story today.
Yeah, and we're going to have more on the payrolls, but everything else that is driving markets today from the White House. Just moments from now, we'll be joined by the chair of the Council of Economic Advisors, Stephen Miran. But first, we do want to check in on the market activity as we close out the trading week here on a sour note. Charlie Pellet has a look from New York. Hey, Charlie.
And I thank you very much, Kailey and Joe. We are just about lows of the session on this Friday, on track for another losing week. It'll be the 6th week of losses in the last 7. The Dow, the S&P, NASDAQ, all plunging again, I might add, right to the numbers with the S&P down 4.7% now, down another 255 points. The S&P at 5140. The Dow down 1,630 points now, lower by 4%. The NASDAQ Composite Index down 800 now, down 4.8%. The 10-year at 3.94%, with the 2-year currently yielding 3.61%. Spot gold moving lower by $85 the ounce, down 2.7%. The precious metal now at $30.30 the ounce. West Texas Intermediate crude down 7.5%, 61.90 on WTI. Bitcoin higher right now. We have got Bitcoin up by 1.2%, 83,302 on Bitcoin. Briefly, Klarna, StubHub pausing their IPO plans after Trump tariffs roil markets. Balance of Power continues. Back we go to Washington. Once again, your hosts, Joe Mathieu and Kailey Leinz.
All right, Charlie Pellet, thank you so much. We'll get back with Charlie in a short time as we're keeping constant checks on Wall Street for you today. This is a difficult period of time for financial markets and a perfect time for us to be speaking with President Trump's economic advisor in the Council of Economic Advisors, where he works as chairman. Stephen Miran joins from the North Lawn of the White House on Jobs Day, as a matter of fact. Mr. Chairman, welcome back to Bloomberg TV and radio. It's great to see you. As we mentioned earlier, this jobs report would be our lead story on any other day, with payrolls blowing the doors off. But after everything we have seen in the financial markets, and knowing that President Trump has now put forth his plans for tariffs taking effect tomorrow and next week, are these data already old?
No, I don't think the data are already old. I mean, look, you know, we're very pleased with the jobs report that we got. The economy created 228,000 jobs in March. That's roughly twice the amount of jobs that it created in either January or February. In fact, it was such a good month that it was, in fact, the fourth best month in the last 2 years for job creation. That's pretty spectacular. And, you know, in spite of some headwinds that folks thought would be material headwinds, the president has acted very swiftly and forcefully to close the border and to prevent the surge of, and to stem the surge of illegal aliens coming into this country. And lots of folks said, oh, that'll be bad for job growth, right? That'll be bad for job creation. Well, this report proves that that might not necessarily be the case. And so what the report shows is the economy is continuing to grow in spite of the president's variety of policies, and it's a good sign.
Mm-hmm. Well, but this report, Mr. Chairman, is by nature backward-looking. I think the concern financial markets have today is about the forward-looking picture and what the economy is actually going to look like in light of these severe tariffs that are being implemented starting tomorrow, the layoffs of federal workers that the Department of Government Efficiency is pursuing. How can you guarantee the labor market will hold up in the face of those challenges?
Yeah, thanks. So look, you know, the president acted with historic scope and speed to address what was a decades-long festering problem that had been eroding our competitiveness and eroding our prosperity and eroding our economy. And so, of course, there's going to be some market volatility on the back of that. Of course, there's going to be some adjustments on the back of that. But on the end of it, you know, things are going to be materially better. And I'll tell you why. Not only will the tariffs incent reindustrialization in America and companies coming back to build in America, but there's also two other legs to the stool that are of significant importance. There's the deregulatory agenda, and then there's the tax agenda. And both of those are profoundly stimulative for the economy. And one point that I like to make is that imports are only 14% of the economy. The other 86% of the economy is affected by the entirety of the agenda. And so that's tax and regulation, and both of those are going to be very important.
I'd like to ask you, Stephen, about the comments that we heard from Jay Powell a bit earlier today. The Fed chair had this to say about the impact, the potential impact of President Trump's tariff regime. Listen.
While uncertainty remains elevated, it is now becoming clear that tariff increases will be significantly larger than expected. And the same is likely to be true of the economic effects, which will include higher inflation and slower growth. The size and duration of these effects remains uncertain.
Stephen, our Edward Harrison writes that unless the labor market data deteriorate precipitously, the bond market is going to have to reverse some of its post-Liberation Day rally, taking stocks down further in the process. The jobs report today is bad news for stocks and bonds, he says, because we're not going to see lower interest rates anytime soon. And the chairman today suggesting that he is in no hurry, even as President Trump puts on Truth Social that this would be the perfect time to cut interest rates. What is your message to investors when it comes to rates here against the backdrop of tariffs?
Sure. So first, let me be clear that, you know, I'm not going to tell the Fed what to do, but I will point out that we lived an experience of tariffs in 2018, 2019 during the president's first term, and there was zero macroeconomic evidence whatsoever that tariffs had any material inflationary impact. In fact, the Fed wound up cutting rates on that event. So I think it's important to understand.
But we're talking a different scope and scale now, Mr. Chairman. The tariffs from the last administration are nothing like what we're seeing now.
Yeah, the president has acted with historic scope and speed. I agree with that. But we also have to appreciate what's going to be happening on the tax and regulatory front. And I think that one of the most powerful things for determining the supply side of the economy is the regulatory environment. If prices are high and increasing because there's not enough stuff, the best way to address that is to make more stuff. That means getting government out of the way, letting firms invest, letting firms build, letting firms produce. And if you make more stuff, you can address not only inflationary pressures, but actually bring some prices down. And I think that that's powerful and arguably much more powerful than any effects of tariffs.
But what is the actual lag time between seeing a lesser regulatory burden, seeing tariffs that maybe would incentivize U.S. manufacturing to invest in that capacity, the lag time between the decision to do that and the actual capacity coming online and whatever employment or what have you will come with it? This isn't going to be an automatic thing, right, Mr. Chairman?
Yeah, thanks. So that's a great point, which is that, you know, the regulatory process and taking away those regulations is a legal process, and that takes some time. And the president has made historic progress in the first 2 months peeling back regulations, but there's still so much work to do. And it'll take some time for us to get that through. And so that's, you know, maybe this is part of why there's market volatility, because implementing the totality of our plans will take some time. Congress is working on the tax package as we speak. It will take some time to pass it. It will take some time to implement it.
We're hearing a lot of concerns about a recession. Money managers are pointing their trades toward a recessionary environment, and JP Morgan today increased odds for its recession forecast to 60%, up from 40. Stephen, what are yours?
Yeah, you know, I'm not a professional forecaster, so I don't necessarily have odds. But what I will say is what I said a moment ago, which is that imports are only 14% of the economy. So you really have to think of, you know, really, really huge, really enormous changes sort of shaking through those things to get to the place where you think a recession is likely as a result of something like this. And as I said before, I think that the president's pro-growth policies on the regulatory front, providing further tax relief to American families, extending the tax relief of his 2017 Tax Cuts and Jobs Act, I think all of that is profoundly supportive of growth. And I think there's maybe a little bit too much focus on risks from what's going on right now, and not enough focus on the pro-growth policies that are
well, we're
being
certainly
implemented
focused
now
on Wall Street. I understood. I don't mean to interrupt, sir, but there's a great worry about the negative wealth effect. This market is in free fall right now. We could continue this next week unless there is some change here in the news cycle as we hear about additional retaliatory tariffs. At what point does this drag consumer spending with it?
Yeah, so look, you know, you're right. There can be some wealth effects. There will be some wealth effects. There will be, you know, there will be ramifications of that stuff. But like I said before, we have to balance that out against the totality of other stuff going on in the policy agenda, the totality of the other strong drivers of economic growth. You know, one point that I've made a lot is that the Biden administration's last 2 years, almost 3/4 of jobs that were created were in government and government-adjacent sectors, and that's profoundly unsustainable to have the government gravy train driving the economy. In the March jobs report, that number came down from almost 75 in the last 2 years of the Biden administration to just about 40, right? So that's a very material decline, and this is part of reconfiguring the economy from a government-driven growth engine to a sustainable, durable private sector growth engine, and this is going to continue.
As we consider the growth outlook, keeping in mind that you did just tell us, Mr. Chairman, that some of this will take time to materialize in terms of the stimulative efforts of this administration, whether legislatively or otherwise, if the Federal Reserve were to decide that it has to prioritize inflation, and if inflation persists and they don't want to cut rates, but we do see a material downward shift in growth or in the labor market, is there a lever that the White House is going to be able to pull more immediately to try to offset those effects if the Fed can't do both at the same time?
Yeah. So again, I'd point you to the forthcoming tax legislation that's being worked out on the Hill, and I think that will allow the president to provide profound tax relief that will be excellent for American families, American workers, American firms.
Well, going forward, Mr. Chairman, I wonder what's going to happen in terms of messaging to this market. Are we going to hear more from the administration, from the President of the United States, from yourself, when it comes to the dollar, when it comes to investing in the stock market in the United States? I know that frequently the refrain is we're seeing companies invest in America, but how about in our financial markets where we've seen, I believe, a half dozen IPOs today delayed, some of them pretty large. We're hearing from some major firms planning to go public as soon as next week that are putting those plans on the shelf. What does the administration tell them?
Yeah, so I'm not gonna comment on specific companies and IPOs, but I will say what I said before, which is that of course there's going to be some market volatility on the back of the president's historic actions. But I also want to redirect you again to what we can do. And so, you know, the tariffs are designed to redress the emergency of trade deficits, but there is a nice side effect, which is they raise a lot of revenue. And if you use that revenue not only to extend the historic tax cuts from 2017, but to provide further tax relief for American families while deregulating the economy and making it easier to invest, build, hire in America, you have the recipe to create an economic boom, wherein America is much more competitive because of the tariffs. It's much more competitive because lower taxes, households, firms, workers keep more of the money they earn every week, and they spend more of it, they save more of it, they invest more of it, and you get the government out of the way so they can build and invest and make factories. And that is the recipe for an economic boom. And if we keep at it, we can create a really great environment for firms to invest and hire, and that will, in the end, in the long run, drive the financial markets.
The other thing that tariffs, you would think, at least traditional economic theory would tell you, would lead to is a stronger dollar, and yet that's not what we've seen in the immediate aftermath of the announcement of these, Mr. Chairman. How concerned are you about a period of sustained dollar weakness?
Thanks. So, look, you know, my view, as I've expressed before, is that classic economic analysis would say that the burden of any economic policy, whether it's a tax, a subsidy, no matter what it is, falls on what economists would call the more inelastic party, but I think is easier for other folks to understand as the more inflexible party. And the example that I keep giving is if you're looking to buy a house and the town that you're looking in raises its property tax rates and you're flexible, you can just look at the next town over. You can change your behavior to avoid the burden of the tax. The person who's selling the tax can't move his house across town lines, so he's got to eat the property tax and lower his selling price. And in that way, the burden of the tax fell on the person who couldn't move his house. And the same is going to be true in international trade. American consumers are flexible. We can make stuff here at home. We can change the countries from which we import. We can stop importing from a country with a high tariff rate and start importing from a country with a low tariff rate that treats us better, that is a better trading partner with us. And that ability to change our consumption patterns, whether to move it home into home production or among different countries, makes us more flexible. By contrast, installed factories in China, they've already spent the capital, the factories are stuck on the ground, the workforce is already trained to build products aimed squarely at the U.S. consumer markets. Those cannot move. So in the long run, other countries, the tariff countries, will end up bearing the burden of the tax, of the tariff. Now, there's a couple ways that can happen. In 2018, 2019, it happened through the currency, but it need not happen that way again. It could happen that way. It doesn't necessarily have to happen that way. There are plenty of other ways they can end up bearing the burden of the tax. It could happen through reduced selling prices.
All right, Mr. Chairman, we appreciate you joining us here on Bloomberg TV and radio. Stephen Miran, the chair of the Council of Economic Advisors at the White House, thank you so much for joining us on this Jobs Day. But of course, while we did get a strong payrolls report, we are not seeing strength, at least in risk assets today. We're right around the session lows on the major equity benchmarks. The S&P now down 5.2%, the NASDAQ 100 down 5.4%. We want to get more on these markets now with Bloomberg's Romaine Bostick, who is joining us from New York. Romaine, I got to say, I'm kind of feeling flashbacks to March 2020 here.
Yeah, not just around session lows. We are at session lows. And just to put this into perspective, Kailey, 500 stocks roughly in the S&P 500. Only 14 of those stocks right now are in the green. We're headed towards what is going to be more or less an unprecedented day. The superlatives pretty much stack up like this. More or less, we're having the worst day since at least 2022. For certain sectors, the worst day since the onset of the pandemic. And if you take the pandemic out of the equation as sort of a one-off outlier, this is quite frankly shaping up to be one of the worst days since the late 1970s. This is a market that is completely shut down, not just in equities, Kailey. We've had several IPOs that have been put on pause. That includes names like Klarna, StubHub, Chime. Several deals that were in the works have also been paused. Not a single corporation has been brave enough to try to sell new debt today or yesterday. And right now, you have this sense of paralysis amongst economists, despite the comments that we just heard from the CEA chair just a few minutes ago. Most economists say right now they have no idea how to chart a path forward.
You know, you talk about the fundamentals in this market, Romaine, kind of falling apart. What about the technicals? We have so many broken charts. Even if the news improved, would that help to lift stocks from where they are now?
Well, keep in mind, you know, a couple days ago, Joe, the support line on the S&P 500 was supposed to be 5,500. Then when we got broke below that, people said 5,400. Right now we're trading right around the 5,100 level. That is the low of the day, 5,104 and change. And so whatever support levels were there, they've been broken. Even when you look at other sort of lines, such as moving averages, Joe, the fact that the S&P 500 right now is in oversold condition, that's where that 14-day RSI dips below 30. Traditionally, these are all lines in the sand where typically you'll start to see a rebound in stocks, the dip buyers come in. You're just not seeing it there right now. The technicals are working against them. The fundamentals, potentially, because of economic conditions, are working against them. So the big question now, right now, Joe, is if you do want to stay in this market, what actually do you buy? What are you brave enough to buy?
Not the truth. The analysts aren't exactly telling us. Romaine, it's great to see you. It's been great having Romaine Bostic with us.
I have a feeling we're going to talk again
these
soon,
very
Joe.
bumpy days this week. I think that might happen. What are you doing at 5? With me in Washington, Kailey Leinz, of course, here on the fastest show in politics, as we try to bridge here what's happening in Washington with what is happening on Wall Street. You can't remove the two here, Kailey, as we reach ever lower, having heard from not only the president, but the Fed chair.
Yeah, the Fed chair signaling they're still not in a rush to cut rates, though it is warning of the inflationary risks of these tariffs. And it's interesting to note, after we heard from the chairman, you saw even more buying coming into the bond market. Maybe that's the only thing anyone wants to buy. The 10-year yield right now down 11 basis points at 392. This is Bloomberg. For equities, the worst two-day stretch since March of 2020 is what we're heading for right now, with a bid coming into the bond market as investors are looking for safety somewhere, keeping in mind they all just heard from the chairman of the Fed. While there may be some persistent inflationary risk due to the tariff policies announced by President Trump this week, the Fed is still not in any rush to lower interest rates, despite perhaps, Joe, the desire of President Trump for them to do so. He actually said on True Social today it would be the perfect time for
Right,
Chairman
today
Powell
would have been
rates.
right before that meeting, maybe. In fact, that was timed to coincide with his remarks. It wasn't until Jay Powell started talking that we saw these new lows on Wall Street, because now the fear is, of course, we're not going to see lower interest rates anytime soon. Fascinating conversation with Stephen Miran at the White House coming off the jobs data today. He continued to point us to Trump tax cuts. They're just getting the ball rolling on that on Capitol Hill. In fact, we're going to have some votoramas over the weekend that could be pretty interesting. We'll be talking about that likely on Monday. But what a treat to have the chairman of the House Financial Services Committee with us. We remember when he was just a congressman. We remember when he was just a community banker. But that's why this is an important conversation, because of the unique perspective that French Hill brings to us from Arkansas. It's great to see you. It's been too long. Thanks for coming in.
It's been great to be back with both of you. Thank you.
So what do you think of this? I know you're sensitive to the markets. You don't like what you're seeing here on Wall Street, I'm sure. The line from Stephen Miran was, just hang on. We're working on extending the Trump tax cuts along with a number of other tax points of tax relief that will help to make this better. Does one offset the other?
Well, I think it's such an important question, and I'm concerned that we cover up the strategy of right-sizing regulation, tailoring regulations, getting balance back in the regulatory system, which President Trump was so successful on in his first term. We want to do that in this term. And as you noted, the Senate will be voting on the House Budget Reconciliation Bill this weekend that'll lead and unlock the ability to block a major tax increase for business and for American households. Those are big, certain issues that I think we can get done. I believe strongly in them. And I don't want to see a tariff strategy, offset that, which is why I believe in trade diplomacy. I think President Trump's right to engage in trade diplomacy, but I believe sincerely that you should target sectors in a very isolated way and achieve results, and do the same thing in reciprocity with countries you think are bad actors that are not open to American products. And then finally, as it relates to Canada and Mexico, I really think the president should advance the negotiations on the USMCA reauthorization of that treaty, that trade arrangement, and let's make some changes. Let's make sure that Chinese component parts are not dumped into Mexico or Canada and go into the supply chain.
So why not have Congress take the lead on that? It is your Article 1 authority to do so, and yet this is being driven out of the White House, not by your chamber or by the Senate. Does that need to change to calibrate this policy in a better way for the economy?
Another good question. Since the late 1920s, Congress had been in the tariff setting business, and they were so frustrated by it and so bad at it that they delegated it to the executive branch under trade promotion authority. But I think Article 1's job there is to make sure we try to get it right, work with the administration to get it right in the Senate's case, ratifying treaties where necessary. So that's what we need to do. Trade promotion authority, which was reauthorized in President Trump's first term, has expired. President Biden did nothing about it. I think that would be a good step for the Congress to consider reauthorizing that.
What is the banker inside you, never mind the chairman of financial services, think about when you hear companies say, why are we being unfairly targeted? All we have done is play by the rules. We came out of China, we went to Mexico, we went to Vietnam, now we're being penalized for that. Aren't they correct in making that point?
Well, I think it speaks to the uncertainty nature of this. I hear it from my own constituents at home who are manufacturers who make something, but some of the component parts and what they make comes from outside the U.S. They're concerned about the cost. Will their product be competitive? And the same is true for Arkansas, a big agricultural state. Right. Much of what we produce goes to Canada or Mexico. So these are important issues, and that's why I think the strategy has to be right. Using trade diplomacy to open new markets, using trade diplomacy to lower rates in certain product categories, like auto and the European Union, for example, and using trade diplomacy to punish bad actors. Those are all important elements of it, and I think that gives some certainty. When you use an across-the-board approach, you get that uncertainty that my constituents are reflecting. So I hope we can work on clarifying that in the weeks ahead.
Well, and in the weeks and months ahead, the White House, as Joe mentioned earlier and you were alluding to, the White House is pushing toward tax cuts that have to happen at some point if the TCJA is not going to expire. I do wonder, though, the argument around that tax package in 2017 was it was going to juice the economy. It was going to put more money into people's wallets. It was going to give businesses more money to make capital investments. Is it going to have the same effect this time around, though, if it's just an extension of what already exists and those people and businesses may be feeling a bit more of a pinch in terms of the margin they actually have to work with to spend that additional capital?
Well, the expensing has been being phased out, and so the renewal of that, I think, will spur capital investment. The R&D tax credit, the same. It will spur new investment. You're right, at the corporate marginal rate or at the household marginal rate, people would just feel relief. Good. I mean, I can count on that going forward. So I think it will unlock some activity in the economy, and it will produce faster economic growth, even if the marginal rates don't change dramatically.
There was a time when revenue from tariffs was pitched as a way to help pay for extending or making permanent the Trump tax cuts. Is that part of the conversation any longer, or are the tax cuts going to be extended in lieu of the tariffs?
Well, in our discussions in the House, I can't speak for the government at large, but in our discussions with our colleagues in the House, we've been thinking about the importance of extending the President Trump's tax cuts, cutting spending, trying to right-size government so that we don't have $2 trillion deficits. This is a major goal of our House Budget Committee, and we're not counting on tariff revenue, because tariff revenue is very difficult to predict. You have countervailing duties. You have people will change their buying patterns. So to automatically assume that you can count on that, I think is not significant or smart. So we have not per se counted on that, and OMB does not count tariff revenue in their scoring. So as we get closer to that final vote, we'll look and see where this Trump tariff plan settles, and that may give us some indication. But in the meantime, we're working independent of that, I'd say.
We were just listening from our colleague Charlie Pellet looking at the markets, specifically at bank stocks, some of the big investment banks that were counting on a revival in companies coming to the public markets and re-engaging in M&A activity. This gets back to the kind of regulatory burden you were referring to earlier. Are you concerned that some of this wider economic impact, companies now deciding perhaps is not the best time to enter the public markets, that regulatory burden being eased maybe for not if they can't actually take advantage of it?
Right. Well, certainly, I hope that the competition focus of a Trump FTC, Federal Trade Commission, is open towards business entrepreneurship, business combination, where it produces more competition. And I would hope that we are able, in our regulatory focus on capital formation, to encourage more public companies because we lower the cost quarterly of being public. That's a goal of mine as chairman of the committee. But anytime you have wide market uncertainty in equity prices, you're going to have people pull back from a scheduled IPO because they need market certainty. Right. And so I hope this settles down soon, because I know there's a lot of interest in advancing that equity market through the IPOs.
We've been talking, Mr. Chairman, for the better part of 10 minutes, and somehow Kailey Leinz has not asked you about crypto.
I was saving it for last.
About the Stable Act. Well, my gosh, we only have a couple of minutes left here.
Yeah.
You had an important week when it comes to this. It's something that gets lost in a very noisy news cycle, but this is important, something you've been pursuing for months and months.
This is a real effort for the past 4 years, really, working with former Chairman Patrick McHenry, Ranking Member Maxine Waters, to craft a dollar-backed stable coin under U.S. law inside the largest capital market, the most important economic country in the world, that we would have our own dollar-backed stable coin where we could have a tokenized dollar payment on a blockchain. We had a successful markup, bipartisan result, and this is a companion to just a few weeks ago, Bill Hagerty, Cynthia Lummis, Tim Scott, Diane Gillibrand got a Senate dollar-backed stablecoin bill out of the Senate Banking Committee. This is the first time we're demonstrating, I think, to the markets that we can make progress on this. I think we can get that passed this year, and I think we can also get the market structure bill passed. You've got to link them, because a dollar-backed stablecoin, but without market structure, how would you custody it? How would you exchange it? How would it be used? So they're important that we try to keep them working together. President Trump's asked us to complete that work by the August recess.
Okay, so in terms of sequencing, will we see a full floor vote on the stablecoin legislation before market structure efforts begin, or is that already underway?
I think House and Senate leadership have the best strategy under discussion. Tim Scott, Bill Hagerty, Cynthia Lummis, they're outstanding leaders. They know this issue well, and we know it well in the House, so we're going to craft the best legislative strategy.
All right. How different will it be to fit 21?
We have our first hearing next week. Brian Stile of Wisconsin will convene his first market structure hearing in the House. We're excited about that, and we hope to get that text ready in the next few weeks.
We need a Stile Hill panel.
Yes.
Oh, yes.
When the time comes. Can we do that?
We can do it.
All right.
All right. Well, we'll look forward to it. And we
Great
were
to be
so
with you.
excited to
Thanks
have
for
you
the
in
invitation.
studio
Thank you,
today,
sir.
Mr. Chairman. That is the chair of the House Financial Services Committee, Congressman French Hill of Arkansas, here with us on Bloomberg TV and radio. Interestingly, crypto won bright spot today, I would note,
right?
Joe. If you're looking for haven, maybe you're finding it in treasuries, but maybe a little bit of marginal buying coming into Bitcoin as well. Can't say the same for other risk assets, though, as we're just off session lows, but still down about 5 percentage points on the S&P 500 and NASDAQ 100.
A bit of a bid under Bitcoin, but this is a risk-off market. My goodness, we're still trading near the lows of the session, and we'll have a lot more coming up here on the fastest show in politics. You can't remove Washington from Wall Street. That's why we're here on Bloomberg TV and radio alongside Kailey Leinz. I'm Joe Mathieu. Thanks again to Chairman French Hill. We'll have much more ahead on Bloomberg. A new date to circle on the calendar, Kailey, 75 days. Not a big shock. Obviously, we were creeping up on a deadline in the next 24 hours without a deal in place. It's unclear, though, whether still, I ask, would China sign off on such a deal? Because that would be required for this to happen, and they just put retaliatory tariffs on us today.
Yeah, well, and the president does make reference to that in his post on True Social. He says, we hope to continue working in good faith with China, who I understand are not very happy about our reciprocal tariffs. He goes on to say, this proves that tariffs are the most powerful economic tool and very important to our national security. Keeping in mind, the president has floated multiple times over the last week, lessening the tariff burden on China if it means they agree to a TikTok divestiture.
Tariffs are the most powerful economic tool, though, I guess, in generating reciprocal tariffs and in sending the stock market lower, because that is what they have achieved today. Commentary from Jay Powell seemed to only make it worse.
Yeah, well, and we want to get some more commentary of our own here on this program as we bridge Wall Street and Washington and turn to Democratic Congressman Glenn Ivey of Maryland, who is here with us in our Washington, D.C. studio. We have much we want to discuss with you, sir, and welcome back to Bloomberg TV and radio. First, though, as I know you did vote for the legislation that included this divest or ban law for TikTok, another 75-day extension. Does this go against the nature of what that law was actually supposed to achieve?
Yeah, it does. And if you look at what they did over the previous extension that the president gave them, as far as seeking a business solution, I didn't see really any effort to do that. So extending them 75 more days to do what is the question that I have. If they're not really going to be trying to figure out a way to resolve this from a business perspective, then they're just playing a stall game, and the president's falling for it. So I hope he'll get out of the way of that. I don't think he really has the statutory authority to do what he's doing here, but you know, we'll see how it plays out.
Well, in the time that you were preparing to vote on that bill, the bipartisan case was established that this was a national security threat. Has any of that changed?
I don't think so. And if you look at the ads that they run, which never mention ByteDance, but float all these nice people in Middle America who are making money using TikTok, and we all know that that's the case. But the fact that they're continuing to push it and act like this is only about TikTok and has nothing to do with ByteDance, I think indicates how the potential for misinformation and disinformation can be spread through this, and they're doing that very aggressively and apparently pretty well.
Well, so there's the national security element of TikTok. I guess there's also the national security element of something that the president is now tying to TikTok, which is his tariff policy, maybe using it as leverage in this particular instance. But overall, as we consider the tariff regime that was announced by the administration this week, I'm wondering what you're hearing behind the scenes from your colleagues in the House, not just from your fellow Democrats who are obviously making their feelings well known, but from Republicans. Are they saying things to you in private that they're not willing to in public about this?
Yeah, but I mean, you're starting to actually see them say things in public too.
Sure.
I mean, the loud screams you hear in the background are not just Democrats and average Americans. They're Republicans who see this as maybe one of the biggest political blunders that I can recall in recent memory. This is a total unforced error. The economy was moving in a relatively good direction. Whether you like what Biden did or not, when he left, the U.S. economy was pretty much the envy of the Western world. Trump inherited a good economy. The jobs report that just came out indicates that things were moving in the right direction, probably. All he had to do was kind of not get in the way, and this is driving the truck off the cliff. I've never imagined that he would do this. And then to do across-the-board tariffs on every product for almost every country at the same time, and then act like you're going to negotiate with all of these at the same. It's ridiculous. I'm not sure what he was thinking when he did this, but I don't know what the exit ramp is. I don't really see one. He's mad at Powell for not giving him one, but Powell did, I think, what people were expecting the Fed to do under these circumstances.
Well, the impact locally for you is very real. It's not just the tariffs here, and that's obviously hitting people across the board. The market reaction hits people across the board. The DOGE cuts, though, hit you directly, with federal workers who live in your district who are being shown the door. Then you add what took place with some of the budget cutting. I know that the House has yet to reverse the budget cuts for the District of Columbia, but people are starting to sit back around here. We're on global television and radio right now. People are listening to you as well on 99.1 FM in Washington saying, hey, wait a minute. The Washington, D.C. area, the DMV, used to be recession-proof because of the fact that the federal government was here, or at least there was a shock absorber, Congressman. Does that exist anymore?
Maybe not. What he's done in the attack on federal employees is been extremely damaging. I mean, he's thrown people's lives up in the air, and I know there's a lot of people who don't have sympathy for so-called bureaucrats, but people are now starting to feel the impact of the services that they're not getting because these people have been fired. And some of these things are going to be very long-reaching and far-reaching. So, cutting the clinical trials for Alzheimer's, cancer, Parkinson's. My father died from Alzheimer's and Parkinson's, a combination of those. So to see the clinical trials derailed just kind of, by happenstance is astonishing. And then the impact on, people who are seeking their PhDs or starting their research careers. We're going to have IonQ on here in a minute, but, China's throwing money at AI, quantum computing, and the like. They're trying to grow as many of these scientists and engineers as possible. Trump's cutting the money for that, and that's just scratching the surface. I mean, we could go through, the impact Medicaid cuts, impact on elementary schools, the impact on local hospitals in rural and urban areas. I mean, it's astonishing, it's far-reaching, it's extremely damaging, and I think when you combine that with the tariffs that he's put in place now, you're certainly looking at a recession in the Washington metropolitan area, but I think you're probably looking at one nationally as well.
You mentioned IonQ. This is a quantum computing company that you introduced us to some months back, and you were joined on the air here by the then CEO. Niccolo de Masi, the president and CEO of IonQ, now in charge of the company, joins us now as part of our conversation. Niccolo, we want to add your voice to what we're talking about here and welcome you to the conversation. With a lot of questions we have about quantum computing and the charge that you have at IonQ, been pretty remarkable hearing you called out by Jensen Huang recently, but there are great concerns now about a company like yours seeing innovation stifled and having more difficulty accessing capital because of what's happening in the financial markets driven by the tariffs. What do you think?
Well, first of all, I want to thank the Congressman for including me in this and thank the Congressman for all the support that he's given to IonQ. You know, we were born on the University of Maryland campus 30 years ago with Dr. Chris Monroe. And we, of course, do a lot with the university, the ecosystem, with the DMV, and, of course, with all the associated, ecosystem of agencies in the area. You mentioned China. I mean, absolutely, they are investing, probably $15 billion officially in quantum computing, and I bet it's more unofficially given how things work over there. And I would concur that quantum computing and quantum networking, which is the other half of our business, so it's safe making and safe breaking, really are not just paramount for the national security of our country, but they're fundamental to the economic growth prospects of our economy. And so, we work, of course, across the aisle. We work with the administration, every administration, and it has been a bipartisan issue, which we're grateful for. I mean, our machines are made in America. Our quantum networking also is rolling out in America in places like Tennessee, for example. And ultimately, we believe that, tariffs will be a far bigger issue for companies that are structured differently than IonQ. But nevertheless, we look forward to continued support in the state and, of course, federally as we continue to grow this vital technology for our country.
But what about the notion that, at least in terms of China's retaliation against the U.S. policy announced this week, it's not just tariff measures, but also restricting access to critical minerals? Is that something, given the role that those play in quantum computing, that could affect your company?
Well, it can affect some companies in the quantum computing space. Fortunately, it doesn't impact IonQ. Just yesterday, DARPA, in fact, awarded us the first stage of their own journey towards building, let's call it encryption cracking and encryption protection. So, the basis of modern civilization relies on secure communications. Battlefield of the future relies on Battlefield of today relies on secure communications. And ultimately, quantum computing helps you both optimize that, and quantum networking helps you ensure that e-commerce, banking, you name it, as we know it today, goes on, perpetually. Right. So this is an issue that, we fortunately are well funded. Our stock, of course, has not had a great day today, but our stock has had a better day than everybody else who's exposed, fully to these measures for sure. We're heartened by the fact that we've got such strong support in Maryland and many other states, as well as in the federal government. They all recognize the criticality of information, the criticality of optimization, the criticality of computing. Jensen Huang will see us as a competitor someday, but at the moment, we're just expanding the compute market with quantum processing units. And our technology that you can see behind me is actually what's called an ion trap quantum computer. And we don't have to import any minerals for this, fortunately.
This is really impressive stuff, Congressman, which is why, of course, you introduced us to IonQ. Knowing that they're working at the University of Maryland, how concerned are you about federal grants being withdrawn or being challenged by this administration and testing the innovation of a company like this?
It's extremely problematic, and we've got other entities. Johns Hopkins is in Baltimore. They're outside of my district, but they just had to lay off 2,000 employees based on what the administration had done as far as cuts. And if we're looking at growing the field of scientists and engineers, they're coming up out of college, out of graduate school, and getting into these professions now. He's wiping out the grants that they use to do their research. He's wiping out the indirect cost payments so that allow these universities to do it. He's wiping out the grants and, in some instances, contracts that go to federal agencies like NASA, where the research is done. So we've got this crop coming up with no place to go here in the United States. By contrast with China, they're not only are they, growing more of these people faster, but they're throwing dollars, or the Chinese equivalent of that, into funding it so they can expand it quickly. We're still in the lead, but the president's walking us off the field right now, and when we should be competing and maintaining the lead that we have.
Well, Niccolo, we only have a minute left, but can the private sector make up for anything or the lack, I guess, of investment or a pullback in investment from the public sector?
We're doing our best, Congressman, for sure. We're trying to grow the job market, our quantum center that we have in partnership with, of course, Maryland and UMD, and we're very much part of, and I think a central tenet of the quantum initiative and expansion of our headquarters to create those research opportunities, create companies and incubation and entrepreneurship around our technology. So, we're well capitalized, and we'll do all we can every day. Needless to say, though, we rely on partnerships with Maryland, the university, the federal government, to ensure that our technology makes it into the commercial sector, the public sector, onto the battlefield, into drug discovery, into let's just call it aerospace of the future and optimization opportunities of the future every day of the week. So let's hope that this is a moment in time and that it's all up from here for both of us.
All right, Niccolo de Masi, President and CEO of IonQ, joined by Democratic Congressman Glenn Ivey of Maryland, here with us on Balance of Power today. Thank you both so much for joining us. We'll be back for more in the late edition of Balance of Power coming up at 5 p.m. Eastern Time.
Where else are you going to hear a conversation like that but on Bloomberg TV and radio? And don't forget to subscribe to the Balance of Power podcast. Hear our full conversation with Congressman Glenn Ivey. Go to Apple, Spotify, wherever you do your podcasts, and listen anytime at our website. It's Bloomberg.com.